Right, on the agenda, brief introduction and highlights, financial review, talk about the capital management of the company, the operations and the operating environment, split between the three major components to our business today, which is the South African portfolio, Growthpoint Australia, and the V&A Waterfront. Look at the acquisitions, disposals, and developments commitments, what's in the pipeline. Touch on the revised offer that we put out for Fountainhead last week, and then look at some prospects for what we may expect the next 6 to 12 months. So for those who don't know Growthpoint, we are the largest listed property company on the Johannesburg Stock Exchange. As Mike said, we are in the Aussie Top 40. Our total asset value at December was 55.7 billion rand, and that included the South African portfolio, 100% of Growthpoint Australia, which we consolidate, and our 50% share of the V&A Waterfront. Market cap at December was 43 billion. As Mike mentioned earlier, it's up a bit from there to 46 odd billion today. We own 390 investment properties in South Africa, 43 in Australia via our subsidiary, which we own 65.3% of. And then there are obviously a number of properties within the V&A Waterfront, which we own on a collective basis. We own 50% of the entire V&A, together with our partners there, the PIC, on behalf of the Government Employees Pension Fund. At December, the retail portfolio was valued at 13.5 billion, office 14.8, industrial 7.5, Australia 14.8, that's 100% of the Australian business, and then V&A Waterfront at valuation 5.1 billion. We are what we call a fully integrated, internally managed property company. We employ 457 people across the country. That number excludes staff at the V&A Waterfront, and it also excludes our team in Australia, which is a very small team of only 11 people. We have offices in Sandton, in Cape Town, and in Durban. Look at some of the highlights for the period under review. Total or 19.4% return for the 6 months on an annualized basis, representing an income yield of 6.3% and capital growth of 13.1%. Distribution growth up 7.2% to 72.7 cents, slightly ahead of what we guided the market at our last year-end results, where we guided for growth in the low sixes. And certainly as a management team, we're pretty pleased with the performance. Average growth over the last 5 years in distributions was amounted to 7.3%. In the period, we invested just short of another 180 million rand into Australia. The total cost of our investment in Australia now sitting at 3.2 billion rand, and the market value of our investment there at December 4.9 billion. The investment was essentially through us following the distribution reinvestment plan that the Australian subsidiary is also offering. And certainly we as Growthpoint have also, as part of our results or part of our dividend declaration now, offered to shareholders the ability to reinvest their distribution into new shares, final pricing still to be determined. The Australian business continues to perform extremely well. We had a 31.1% annualized return over the 6 months, with an income yield of 11.7% and capital growth of 19.4%. We issued new equity during the period amounting to 613 million. That was essentially through the support of 59.4% of our shareholders who elected to reinvest their distribution in September. And then on an operational side, we introduced in November last year what we call the undeposit, which is quite unique, I think, in the property space, not only here in South Africa, but also globally, whereby on going forward, we are no longer looking to take deposits from our tenants, which I think has been something which has been a phenomenon in the property industry, certainly as long as I can remember. Growth in distribution over the last 4 to 5 years. You can see steady growing income, growth rates of 5.8, 8.1, 6.1, and as you'll see from the prospects later on, and we did publish that in our SENS announcement yesterday, we're guiding the market for between 7 and 7.5% growth for the full year. Steady growing income, part of our plan and part of our offering, I guess, as a listed property company, is steady growing income over the long term, which should hopefully translate into capital growth, and we do believe that is what has been delivered. Similarly, if you look at the growth in assets, the growth in market cap, share price, and our NAV per share, reflecting steady growing trend over the last 5 years. We get stuck into some of the financial dynamics. As I mentioned, today Growthpoint really has 3 major contributors to its bottom line, being the South African portfolio, which is a mix of retail, office, and industrial properties, the Australian business, and the numbers that are reflected there are the 100% of the Australian business, and then the V&A waterfront. So you can see today, you can basically see the change in mix or the diversification, where a couple of years ago, certainly if you went back to December 9, it would have been 100% South Africa. Today South Africa represents about 69% of the what we're calling net property income after operating expenses. That's essentially the same as EBIT, earnings before interest and tax. The Australian business making up 24%, and then the contribution from the V&A waterfront at about 7%. Try and look at a simplified income statement. We always publish this as opposed to the IFRS income statement, which I don't think, certainly I don't understand anymore. But this tries to highlight for you the financial picture for the 6-month period. Gross property revenue grew at 14.9%. In South Africa at 7.9% to just short of 2.2 billion. Growthpoint Australia gross property revenue grew at 46.5% to 658 million. The growth in Australia is largely attributable to the additional investments that the Australian subsidiary has made and the acquisition trend that the Australian subsidiary is still on. We're still in an active growth phase in Australia to grow that fund to size. On the property expense line, property expenses grew at 9.7%, 5.6% in South Africa and 52.1% in Australia, leaving you net property income up 16.3% to just 2.25 billion. Other operating expenses grew at 45%. 42.9% up in South Africa and 45.6% up in Australia, leaving you with net property income after operating expenses or EBITDA at 2.14 billion, up 15.2%. Finance costs were up 12.7% to 938 million, and finance income was fairly flat at 205 million. Important to note that for accounting purposes, we include the income from the V&A waterfront in finance income, whereas on the previous slide we try to just give you a better picture of the relative contribution to EBITDA. So that's just the accounting convention forces us to put that as finance income. We adjust then for some minority interests in the Australian subsidiary and some foreign exchange profits, leaving us then with distributable income at 1.285 billion for the 6 months, up 11.4% compared to the previous comparable period. If you look at some of the key ratios that we focus on, our expense to income ratios, pretty stable across all 3 the contributing components to our business. In South Africa, 27.6%. Made up of just short of 24% on the property expense ratio and 3.7% on the operating expense ratio. In the V&A, 27% property expense ratio and 5.6% on the operating expense ratio. And in Australia, an 11.1% property expense ratio and 4.4% on the operating expense ratio. We are continuously still looking at obviously fine-tuning the cost structures at the V&A waterfront, but I think it's fair to say that given the nature of that asset and the complexity of that asset and the diversity of that asset, It does warrant and justify higher cost-to-income ratios, but notwithstanding that, we are benchmarking it as best as we can to see whether there are further efficiencies that we can extract from there. On the Australian side, the low cost-to-income ratio pretty much reflecting the historic situation where it was originally a 100% industrial portfolio. Today, it's closer to a 50-50 between industrial and offices, and you'll see the increasing trend in the in the property expense ratio as the mix in the portfolio changes between industrial and office. On the balance sheet, total property portfolio, South Africa and Australia at 50.6 billion. That's up from the 48 billion in June 2012. Our 50% investment in the V&A waterfront at 4.9 billion. This is the accounting investment as opposed to valuation. Borrowings at 20.8 billion, up from 19.7, leaving us with linked unit holder interest or NAV at just short of 30 billion rand. Movement in the property portfolio over the last 6 months. You can see on the South African side, not a huge amount of movement, certainly not on the acquisition side. Mainly disposals, 382 million rand worth of disposals, and then development capital and or development capex and capital expenditure 412 million, giving you a subtotal of 35 billion, and then the fair value adjustment amounting to 835 billion in South Africa, taking you to a closing balance of 35.8 billion. That's split between the long-term property assets and properties held for sale. At December, we had 620 million rand worth of properties held for sale. More activity in Australia, as you can see from there, 524 million rands worth of acquisitions. Foreign exchange translation, clearly quite a steep weakening of the rand to the Australian dollar during this period. And then development and capex, in a development capital and capex in Australia of 602 million, giving you a subtotal there of 14.8 billion. Very small fair value adjustment and a closing balance of 14.8. We also had one property that was sold in December, amount which is shown there as properties held for sale at 618 million. So the total for Australia and South Africa, at the bottom line, at the end of December, 50.6 billion. And to get to the 55 we spoke about on the first slide, you need to just add the V&A at the 5.1 billion, 5078. Fair value adjustments for the period were quite low, in aggregate between Australia and South Africa, amounting to 1.7% of the investment property portfolio. If we touch on capital management and look at some of our debt ratios, again, key numbers that we monitor and all the time. Our loan to value ratio in South Africa, pretty stable at 33%, with our interest cover ratio at 2.7 times. So again, reflective of conservative gearing and conservative gearing policies. In Australia, our gearing is, bear in mind on the South African numbers, that includes whatever debt we took on board to buy the V&A waterfront. In the Australian subsidiary, our gearing is a bit higher, where we're sitting with 46%. It's slightly up on the comparable period and on the June number, but pretty good interest cover as well at 2.3 times. We do have a strategy on the Australian subsidiary to systematically bring down our gearing at the right time and through the right mechanisms. We'll strive to bring that gearing down to the 40-45% range, but it would probably need to coincide with a transaction or an acquisition. At the moment, it doesn't make sense to issue equity at a forward yield of circa 8% in Australia to settle debt. New debt in Australia, our current debt is probably costing us just around about the 7% level in Australia, and incremental new debt is probably close to 5.5%. So nonsensical to raise equity just for the sake of settling debt. But when we look at new opportunities, we may fund it with more equity and less debt. We've continually tried to diversify our source of debt funding, and you can see from the slide here that we have changed our mix between bank debt and debt from the debt capital markets, where today or December we had about 28% of our total debt funding coming from the debt capital markets, and traditional bank debt representing 71.7%. And that is changed from about 24% in the debt capital markets at June and 75% for traditional debt at June. Also important for us and active management by our treasurer is to increase the exposure to unsecured lending. So you can see again we've gone, total unsecured debt's gone from 39% to 41% of the total. And secured down from 61 to 58. So we do continue to look to increase both our exposure to unsecured borrowings as well as to the debt capital markets. First 2 points on this slide just re-emphasizes that with a longer term strategy to probably end up with a mix of 50-50 between borrowings from the debt capital markets and the banks, the traditional banking debt. In December, we issued a 500 million rand 5-year bond, which was mainly utilized to refinance bank debt, and that would be a trend going forward to systematically refinance some of the bank debt with debt from the debt capital markets, where currently we're still seeing between 20 and 40 basis points improvement on the margin by borrowing from the debt capital markets as opposed to from the banks. We raised 613 million of equity through the DRIP. We issued commercial paper or refinanced one of our commercial paper issues in December at 19 basis points over JIBAR. We actually had a roll yesterday or Monday? Monday we had a roll of 500 million of CP, which came in at 20 points. So I think we've got to a level of 19 to 20 basis points for CP, but clearly our use of CP is limited. It is short-term in nature. There's generally volatility there, and we have various risk management policies in place to ensure that we don't abuse funding on the short term. 85.5% of our interest rates were fixed for a weighted average duration of 4.7 years. Slightly higher level of fixes for slightly shorter period, 4.7 versus 4.9 years. The weighted average interest rate remains at 9.5%. We do note a trend amongst some of the listed property companies to break their interest rate swaps and move more towards a floating rate environment or refinance given the current low interest rate environment. We believe that is essentially looking to just smooth your earnings, where you're converting capital charges in terms of the breakages of the swaps to an income statement benefit. We haven't done any of that, and we will continue to, I guess, just monitor the situation. I know that one of the analysts in the crowd has made a comment about the potential danger of boosting your distributions quasi-artificially by playing with these interest rate hedges. Weighted average term of our loan book has increased to 4.1 years, from 4.1 years to 4.2 years. We have about 2.5 billion rand worth of committed unutilized facilities. Moody's maintained a stable outlook on our rating, and then certainly from a treasury policy perspective, we continue to remain well within all our guidelines and within all of our covenants with our banks and with the institutional investors in the bonds. One of our key policies is that Growthpoint will ensure that cash flows from operations plus available credit will exceed committed cash outflows and debt maturities in the next 12 months. A discipline I think that certainly Moody's have instilled in us. And then Growthpoint will also look to fix a minimum of 75% of our interest rate exposure. Right, operationally, if you look at just the South African portfolio and the mix between the contribution from retail, office and industrial, I think what I'd like to highlight on the slide is that this, in my mind, certainly presents a pretty stable picture, a pretty steady picture. Again, growing income streams from the portfolio. Retail had a particularly good year in terms of its growth in contribution, 581 versus 521. Office, Rudolph asked me to please speak highly of office and give it a bit of a punt, but unfortunately I said to him I'm struggling. Offices are still battling a little bit. A slightly lower growth in contribution from office, but also obviously that takes into account that on the disposal side, the bulk of what we disposed of was office space. And then industrial, also performing pretty well at, I think it's just over 10% growth from 396 or to 396 from 359. So pretty stable picture on the South African portfolio. Further analysis of the South African portfolio, our net property income grew at 8.6%. And if we adjust that for the impact of acquisition and disposals to look at a like-for-like picture, we see that retail grew at 8% like-for-like, offices at 7.6%, and industrial 7.1%. Combined like-for-like net property income growth of 7.6%. Some key performance indicators on what I typically call the property fundamentals. Vacancies at 4.1%, again pretty stable. Total arrears at 48, it's up from our June number, but very consistent with our previous December number. Definitely a trend in December where arrears normally spike due to us closing off our books earlier and our collection efforts probably not as vigorous in December with a lot of staff on leave, but also many of our tenants go away in December and come back in January and pay 2 months worth of rent. They forget to pay their rent conveniently in December. Bad debts very much under control, 7.1 million, again comparable to the previous the year end as well as the 6 months. Within the 7.1 million, important to understand that actual write-offs was just below 4 million and that we had an increase in our provision of just over 3 million. So the total charge to the income statement made up of write-offs of just over 4, which is exactly the same number, in fact, as we had in the 6 months to December 11. But in the December 11 number of 2.6, we had a reversal of provision, bringing down the total charge to the income statement. Average in-force escalation still at a healthy 8%. The renewal success rate slightly down to 71.2%. Weighted average rental renewal at 2.9, again a fairly steady trend over the 3 periods that are reported there. Future escalations at 8.3%, and net property income per employee growing from 3.4 million to 3.6 million if you compare it on a 6-month basis. Quite a lot of detail here, I'll try and get through it quickly. On the retail side, again if you look at the property fundamentals, vacancies sitting at 2.9%. That's down from 3.6. Within the top 10 centres by value in our portfolio, the vacancies at 1.9 and the balance of the portfolio at 4.7%. Total arrears 24 million, bad debt provision 6.9, but 2 million up from the 4.9 at December 11. And the renewal success rate running at 80% and rental renewal growth at 5%. So we're seeing turnover slow just marginally at the shopping centres, tracking retailer sales performance, but the retail occupancy cost and the cost to turnover ratios remain well within acceptable industry levels. The South African retailer expansion of international brands within existing operations, in particular Edcon and Foschini, as well as interest from European and Australian and international retailers is creating demand at some of our prime centres. So we've seen the introduction of the likes of Zara, Topshop, where's Stefan? I saw him earlier. Cotton On and various others. We had a meeting in our offices again just 2 weeks ago with another group from Australia. Certainly there seems to be quite a lot of interest from Australian retailers wanting to come to South Africa and more of the UK retailers as well. Vacancies are at historical average and the vacancy level of the top 10 centres is below 1.5% if areas under development is excluded. Second tier shopping centre performance is under pressure in terms of tenant retention, renewal, rental levels and arrears. Cost containment remains difficult, especially labour intensive services and administration costs. Implementation of the new municipal valuation role in 2013 could also have negative impact as we expect rates increases above inflation again. And then the redevelopment, refurbishments, extensions are progressing very well with extensions to Brooklyn Mall, Colonnade, Warmer Park, Waterfall Mall and Northgate expected to open for trade between Q3 2013 and Q3 2014. On the office side, As I mentioned earlier, this is still the sector which is lagging behind the other two and probably finding it the most difficult in terms of trading environment. You can see the vacancies moved up from 6.7 to 7.1%. Total arrears pretty stable at 14 million. Increase in the bad debt provision from 5.8 to 7.1. Renewal success rate coming under a bit of pressure, down at 65.3 from 72.6. And renewal rental growth at least showing positive, whereas for the prior or the comparable 6-month period, we were actually at minus 4.4%. So the ongoing challenging economic conditions resulted in the loss of several major tenants in the first half. When we say loss, we're not talking liquidation per se. We're looking at, we've got a number of tenants that are consolidating or have consolidated and have moved into a different space, vacating some of our space. One or two of them stayed in our portfolio, but a number of them actually left our portfolio. New letting totaled 45, almost 46,000 square meters, and 70,000 square meters of leases expired in the first half, which were renewed. The declining renewal success rate of 65.3% further emphasizes the tough market conditions, and the renewal growth rate remains under pressure but is now at least positive. Arrears are kept under control through continued proactive credit control, ending the first half at 6.9% of collectibles. And the bad debt provision at 7.1%, slightly up due to government arrears at the end of December, but those have subsequently been collected. We see the second half in the office space as remaining challenging with vacancies under pressure. We also have a number of developments and redevelopments that are coming on stream, totaling 36,000 square meters, of which 20,000 has been let, with, and these will be complete before the end of June 2013. So when those numbers come in, if we don't find tenants for that space between now and June, that would obviously add to the vacancy number at June. It is anticipated that a further 2 developments will achieve Green Building Council certification, and that'll bring the total in our portfolio then to 4. On the industrial side, again on the fundamentals, vacancies at 3.1, slightly up from 2.7 in December 11. Total arrears 9.9 million and a bad debt provision of 4.1. Renewal success rate there at 70.5%, and renewal rental growth at 2.7. Continue to see challenging trading conditions, which is echoed by negative factory output data. We see continued increase in input costs, specifically electricity, which is negatively affecting the manufacturing sector in particular. There's an implied pressure on renewal growth and lease periods. There is, however, continued demand for warehousing and distribution facilities, especially those in excess of 10,000 square meters. And we do also continue to see the consolidation trend. Vacancy levels, we reckon, will remain stable around the 3% level. Arrears are stable, and then new development inquiries remain positive. We do have a number of industrial developments, and recently we also entered into 2 joint venture arrangements with private property developers, mainly in the Midrand area, and we hope to find tenants to bring those developments to fruition. Strategy in industrial is to remain focused on reducing vacancies and controlling arrears, unlock value from the existing portfolio. Industrial property, new industrial property has been pretty expensive over the last number of years, and there's a continued focus on mining, if you want, our existing portfolio for redevelopment opportunities. And then we will pursue new development and acquisition opportunities if they are financially viable. If we look at the Growthpoint Australia portfolio, these numbers will show you the change in mix between the makeup of the net property income as well as the property portfolio by value, where you can see an increasing contribution from the office portfolio, and where it makes up about 43% of total net property income today, whereas it was a negligible 9% in the December 10 year. been a deliberate strategy of ours to diversify away from being a pure industrial portfolio in Australia and get exposure to offices. We would desperately like to get exposure to retail in Australia. However, at this point in time, it's unaffordable for us in terms of the yields at which good quality retail trades at in Australia. Again, some key performance indicators. Vacancies at only 0.8% of lettable area in Australia. We have no arrears or bad debts in the Australian portfolio. Average enforced escalations at 3.2%. And then on the renewal success rate and those three dynamics there's no statistics, as there was no renewal in the portfolio or no leases that expired during the period in the Australian portfolio. We have 10 employees and net property income per employee at about 58 million rand. Slightly different model there at the moment still, in that the bulk of the property management, in fact all the property management is outsourced. In South Africa we do all the property management in-house. In Australia we don't have scale yet to warrant bringing the property management in-house, so we only do the asset management in-house in Australia. Distributable profit in Australia was 36.8 million, up 47.6% in dollars, mainly driven by the acquisitions. We paid out 9 cents in distribution for the half year. That was 3.4% ahead of the prior period. The Australian distribution was negatively impacted by withholding tax, which is introduced at 15% and is applicable to approximately 20% of the Australian distribution. So if you take that into account, that pretty much wiped out the dollar distribution growth. But notwithstanding that, obviously the rand depreciated significantly against the dollar during the period. And on a like-for-like basis, our Australian income grew at over 12%, largely due to the devaluation of the rand. 24.1% total return in dollars for our Australian investors for the calendar year to December 2012. The forecast is to deliver 9.3% in distribution for the second half, taking the total for the year to 18.3, which represents 4% growth on the prior year. In Aussie, we have pulled back the payout ratio just a tad from previously 100% payout ratio to a 95% payout ratio. Net tangible asset value at $1.93, shares trading at about $2.40. So at a premium to NAV, I guess a trend which is slowly coming back to the Australian market. The Australian listed property sector has had a 360-degree change from where it was in 08-09. For the best part of 5 years, no institutions wanted to invest in listed property in Australia. Listed property was a swear word. The listed property companies were raising lots of equity, but mainly in a defensive way to shore up their balance sheet and reduce their gearing, whereas today everybody's back on the front foot raising equity to invest. So it is becoming a lot more competitive in Australia, yet we're still finding the odd opportunity which is good for the company. Our management expense ratio remains stable there at 0.4%. And then, as I mentioned earlier, gearing slightly up at 46 odd %. On the equity side, Growthpoint Australia has also implemented the distribution reinvestment plan, and through that, through two of those, we managed to raise $48.9 million of new equity. Growthpoint South Africa, in both instances, has reinvested its distribution into new equity. We continue with a significant increase in market cap, where our market cap today is just short of $1 billion, about $940 million, and the free float is somewhere between $300 and $350 million. So liquidity still not great in Australia, partly due to the fact that we own such a big percentage of it, but as we continue to grow the company and the market cap, the free float will increase. The Australian portfolio delivered 2.9% increase in like-for-like net property income in dollars. We only have a 0.8% or had a 0.8% increase in property valuations. Some of that was offset by the writing off of previous acquisition costs. So the net bottom line, we only had a 0.1%, or we had a 0.1% decrease in property valuations in Australia. We completed 2 fund-through acquisitions in December. and through the acquisition of well-tenanted buildings and high-yielding assets, we have continued to improve that portfolio. The latest acquisition was in December, where we announced the acquisition of 3 industrial properties from which are let to the Linfox Group, probably Australia's top road haulage and distribution company. So Australia has a diversified portfolio of properties, 43 in total, about worth 1.7 billion. We have a very long weighted average lease length there of over 7 years, with growing rental income. 98% occupied. Now the difference between that and the 0.8%, this is measured by income as opposed to the 0.8%, which is measured by lettable area. And then we continue to see, to look for strong growth opportunities in that Australian market. V&A Waterfront, breakdown of the portfolio and the mix of net property income as well as portfolio values. You can see total net property income up just over 6%, 6.2% to 155 million from 146 for the period. If you look at some of the key performance indicators, again, vacancies negligible at below 1%, total arrears of 30 million, bad debts written off 9.6, average in-force escalations at 8.5, slightly above the balance of the South African portfolio. Renewal success rate pretty comparable. Average renewal growth at 6%, certainly better than what we're seeing in the rest of the South African portfolio. And the average escalations at 8% going forward. We have 172 employees at the waterfront, and they are dedicated to managing the waterfront, and obviously all their costs are reflected in the waterfront numbers. A couple of comments on the waterfront. Certainly seeing very strong retail growth in the V&A Waterfront at 18% year on year on a rolling 12-month basis, which is more than double what we're experiencing in the retail portfolio and the rest of the retail portfolio. Our voids in the Victoria Wharf, vacancies 1.2%, and our retail debtors there at 12% and 5% of trading arrears and retail debtors. Footfall continues to grow, quite nicely in Cape Town. In December, I think we hit an all-time record high of 185,000 feet through the shopping centre. There have been quite a few changes for those of you who've been there recently through the opening of the Market on the Wharf concept, which has opened up in the old Musica space where the Musica store used to be. We've opened up Moyo, the Body Worlds exhibition, and the redeveloped food court was also open during the period. The new Shimmy Beach Club on the industrial fishing side, if you want, of the V&A Waterfront opened up in December. It's quite a spectacular new facility, 3,500 square meters, a proper beach club for those of you who know what that is or what that means, and certainly well worth a visit. On the office side, vacancies dropped to 2.4%. So we have just over 2,000 square meters of office vacancies in the waterfront. Most of that is actually currently under negotiation. Trade debtors at 8% of collectibles, and total debtors being continually managed while the focus remains on closing off some of the historic legal arrears. On the hotel side, occupancy levels and room rates have improved very marginally, and we believe that cycle has bottomed out. We did see some numbers from some of the listed hotel operators in the last couple of weeks, and I think that also confirms that the hotel sector has probably bottomed out and looking for improved results going forward. On the fishing and industrial side, revenue continues to be strong and we have no vacancies there. And on the marina side, we spent a bit of capital extending some of what's known as the A spines, creating additional berthing facilities, and that continues to perform well. On the development and leasing side, Allan Gray Development was awarded a 6-star green building rating recently. I think the only meaningful building with a 6-star rating, certainly the only one in Cape Town that's got a 6-star green star rating. The construction should be complete in July. with Allan Gray starting to pay rent around September. We're looking to develop the Portswood Ridge offices into residential. So Allan Gray will be vacating 2 office buildings, if you want. The one is going to remain as offices on the Granger Bay side. The other one on the Portswood Ridge side, we're looking to convert into residential stock. And in fact, that'll be residential for rent as opposed to residential for sale. And we're looking to test the market. Certainly our preliminary work suggests that there will be significant demand. This premises is immediately adjacent to the business school, Cape Town Business School there, Graduate Business School of Business. And we believe that the returns we stand to make from converting that into residential will be far superior to what we could have achieved had we just refurbed it and kept it as offices. Topshop are on track for, we also are developing about 30 apartments immediately adjacent to the Allan Gray development, which will be for sale. Those will be sold on sectional title. Topshop will be opening in late April. We are looking to change or improve circulation at the Link Mall, the very high-end fashion mall, through the introduction of a link between the Link Mall and the Post Office Mall. It'll be known probably as the Cross Mall, which we think will significantly benefit the circulation in that section of the shopping centre. This will also open up additional retail space within the Victoria Wharf. And then a very exciting project for us is the relocation of Pick n Pay. Pick n Pay currently occupy about 2,600 square meters in a store which has got a pretty inferior offering. We're giving them some new space effectively in the basement, in the parking area. The store will be in excess of 6,000 square meters and will offer a full spec similar to the one at the bottom on William Nicol Road at the bottom of Republic. Acquisitions, disposals, developments and commitments. Move through this fairly quickly. Some of it been mentioned already. Not much activity on the South African side. Main activity happening in Australia, as you can see, Growthpoint Australia, 524 million acquisitions, developments and commitments. All in total between South Africa and Australia, we had 537 million of purchases, 382 million of disposals, just over $1 billion in development capex, developments and capex, and future commitments of a further 1.5 billion, just under 1.1 billion in South Africa and about 400 million in Australia. Properties where we spent in excess of 30 million include Brooklyn Mall and Design Square, Lakeside 3, an office building in Centurion, Grand Central Office Park, an office building in Midrand, and then the Meadowbrook Industrial Estate in Meadowdale. We have capital commitments, as I mentioned, just over 1.1 billion, some of the key or the big numbers listed below. And then Growthpoint Australia has got capital commitments for acquisitions and developments of just short of 400 million. That relates to the recent acquisition of a piece of land in Western Sydney, where we will be developing a warehouse property for Linfox. Some of the other major developments, Waterfall Mall extension, we're spending about 216 million there, adding just short of 10,000 square meters. The Grand Central Office Park, it's 111 million development of a 7,000 square meter office park. 4,600 of that has been let, with 3,000 to the Gautrain Management Agency. Mainland Corner, 213 million rand development, 10,000 square meters of office space, 3,600 has been let to Liberty, the balance still to be let. Lakeside 3, 6,000 square meter redevelopment, 92 million rand spend, and that should be complete in the next quarter. Right, the revised offer for Fountainhead, I spoke to a number of people before. Richard, you're not allowed to cringe like that, eh? Before I started the presentation. A number of people are obviously quite interested in what's happening here. So we did increase our offer for Fountainhead last week. It was an effective 5.7% increase in our offer from 35 Growthpoint units to 37 Growthpoint units for 100 Fountainhead units. Importantly, I think as well, and to bring certainty to our offer, certainly our offer was criticized, I guess, early on that we had this mechanism to adjust the price depending on our findings on the due diligence, and we introduced as part of the revised offer a floor, suggesting that our offer will be no lower than 35 for 100, irrespective of what we find in the due diligence. So we have provided certainty to the Fountainhead board and Fountainhead shareholders with regards to an absolute minimum price on our offer. If we just look at some of the numbers and look at what the current premiums are, if you want, on our offer relative to the Fountainhead share price, we currently are sitting, or our offer on the 19th of February, using the prices of the 19th of February, which is the date that we made the increased offer, our offer represented a 13% premium to the closing price of Fountainhead on the day, a 10% premium to the 30-day VWAP, and a 12% premium to the 90-day VWAP. The implied premium, this is using obviously the 37 for 100, and the implied premium to the redefined offer at that date was 857 million rand, or 9%. Even at our floor price, our offer still represents a 7% premium to the Fountainhead price, or that's 665 million rand, and to the redefined offer a premium of 3%, or 252 million. Market obviously changes every day, and as at yesterday's close, or let's say the close on the 26th of February, our offer represented at the high end, at the 37, a premium of over R1 billion to the Fountainhead share price on the 26th, and 927 million rand premium to the redefined offer at the 37 level. So where are we in the process? I guess it's a very busy slide, but in summary, Fountainhead had an exclusivity arrangement with Redefine until the 22nd of February, which was last Friday. That period has expired. It is our understanding, and it was confirmed, I think, in the SENS announcement from Fountainhead, that they have not signed any agreements with Fountainhead yet, or with Redefine yet. And we read into that then the fact that the door should be open for us to re-engage. We are looking to re-engage with the board and the advisors. And I guess from our perspective, we continue to look for opportunity to get to do a due diligence so we can firm up on our price. We're looking to have a level playing field in terms of the offer that we put on the table relative to the redefined offer that's on the table. We have engaged with the Financial Services Board in that regard, who are supportive of a process whereby the two different bidders are able to put comparable offers on the table. We need to engage with the board and the advisors and the FSB, the regulators, to get to a position or a point where a fair process can be run. There is a complication, which is the threat of litigation. We're still unaware of the exact nature of these threats and the legal basis for these threats. We hope that in time that information will become available to the market so that we can plan accordingly in terms of executing the transaction. So our view remains that the Manco has no right to share in the income generated by the Fountainhead Property Trust assets. The Manco has no form or proprietary right in the assets or their proceeds, and the Manco has no valid basis for a damages claim against either Growthpoint or Fountainhead, and will not be entitled to interdict the transaction. Process going forward, we're looking to engage as soon as possible with all interested parties and to be granted opportunity to do a due diligence so we can firm up on our price, and in the best interest of Fountainhead unit holders, give them the choice between the offers on a comparable basis for them to then choose which offer they want. I think the numbers are compelling in terms of the premium that Growthpoint offers, and we hope that all stakeholders will take that into account. Very briefly then, prospects. On the South African side, the economy remains sluggish. We saw the budget speech yesterday, disappointing, I guess, in terms of projected growth. Only 2.7% GDP growth for 2013. Negative impact, obviously, by the labour unrest and job losses. Consumer spending continues to come under pressure, which will impact the retail sales and some of the performance of the retail assets. Demand for office space remains weak. However, the property fundamentals still remain pretty stable, with vacancies low at 4%, arrears fairly negligible, and our property expenses remain under control. Access to capital and debt remain good. Interest rates are projected to remain low at the current levels for the next 12 to 18 months. Good investment opportunities are hard to find. The REIT legislation has now been promulgated, and property loan stock companies will be able to convert after the 1st of April 2013. Growthpoint and the Growthpoint board have resolved to convert to a REIT, and we will do so effective from the 1st of July 2013, our new financial year. That will also coincide with the adoption of a new memorandum of incorporation. Distribution growth in total on a consolidated basis then, guidance of between 7 and 7.5% for the year to June 13. On the Australian side, the economy is still showing fairly robust growth. Demand in the office sector has slowed a bit there. However, the industrial sector and demand for quality industrial space remains robust. Investment demand, particularly from international investors, remains very strong, and we're starting to see cap rates, discount rates, and yields come down in the Australian market. Again, the property fundamentals remain very, very good. In terms of our own portfolio, we have very negligible vacancies and zero arrears and bad debts. Distribution of 18.3 cents for the year has been reconfirmed, and that represents a payout ratio of 95%. Based on the closing price this morning of about $2.39, that represents on a rolling 12-month forward basis somewhere between 7.75% and 8% yield in Australian dollars. V&A Waterfront, looking at ongoing improvements being made to the development master plan. We've seen significant improvements in letting of major vacancies. Exciting new redevelopment opportunities in the Victoria Wharf shopping centres, as I mentioned before. Allan Gray to complete in July, with the lease commencement in September. And then the V&A remains on target to deliver budgeted distribution growth of circa 7%.